Hi folks, gold lost its shine even further by falling to bounce from a critical horizontal support. Therefore, my bias changed to bearish in the short term at least, and so many investors might have downgraded their bullish scenarios. I will explain what is the likely downside path in the price of gold and the likely time horizon for a potential loss of 6%. And finally, we will look at the price of gold from an international perspective because not everyone is trading gold for US dollars. Depending on your base currency, the technical situation might change a bit and therefore also influence your investment decisions. We have a lot of things to dive into in today's video. If you guys enjoy, consider dropping a like to support the channel. Gold eroded a long-term horizontal support at approximately 1677 very decisively, printing a large red candle at the breakout and paused yesterday, and today resumed its downward movement to close the week really in the red. The likelihood for those upside projections here to materialize is starting to dwindle, but we keep the intersection intact, not as a price target, but as a timing clue that is right now points to November 22. By the end of November is where we have the intersection. So therefore we could use this intersection for an eventual upside breakout later on, or a reversal at lower levels. The descending blue line implied by the channel floor looks now vulnerable and could be taken out next week. We see this blue line originating here in August 2020. We had another contact point here in May last year, and then we have a little bit of a false break here, an outside excursion before we had this settlement here, and then finally the last rally here to the top in March this year. We might think that this line, because it got a false breakout here, is not valid anymore, but it changes if we look at the very same line from a monthly perspective. We do see that we had for that moment, at least from a monthly perspective, we see that we had that excursion outside of the descending support resistance, but it just pierced outside of it. It was the following month that when we had the breakout, and then the subsequent month the pullback to that very same broken level, and then the rise up north to the highs above the 2000 figure. So by changing the time frames, it allows us to assess if a line makes sense or not, if it could be valid or not. These lines they follow a certain guideline. It's not that these are the absolute valid lines. Usually, if you look for lines that have an approximate 45 degree in inclination, you can find a lot of them and just work the parallels. It will depend where you place the lines, where you let the lines cross, and there are a few guidelines that I will be presenting in the following videos, but there are no lines that are right or wrong. The lines just serve for you to establish, let's say, a technical landscape. You want to know through the lines, you want to know where are the areas of the price, where the price action might find higher levels of liquidity that is at the lines, and where the price might travel faster in between the lines. The price easily gaps in the areas between lines from one area from one line to the other. And when I see gap, it's not a gap in terms of chartist theory, but a level of less or decreased liquidity that makes the price accelerate. So depending on your methodology, you can then, once you have the landscape structured, you can then trade breakouts, you can trade reversals, you can get into momentum trading through these areas, momentum trading from one line to the other. For example, if you trade reversals, you wait for bumps against the lines, and then you trade from there. And then plus you have the intersections, which give you a very good time information when these accelerations, these breakouts, and these reversals might occur, not only in terms of price, but in terms of time. So the aforementioned horizontal support at 1677 may now flip to resistance. The price may snap back a little bit higher before continuing down, but if it doesn't, then the downside gap, that is the magnitude of the deterioration, as I was explaining, may be bigger than expected. Intraday charts here, from an 8-hour perspective, we might switch to the daily first, and on the daily chart we already see here a potential steeper line emerging here, and it's on the intraday charts that we see a new channel emerging here. Usually, like I said, I tend to use an angle close to the 45 degree. This line becomes very steep if we go and look at the weeklies or monthly charts. So I don't make them appear on such higher time frames. And if we go very low, the lower we go, the flatter the line. So you don't want to use very flat lines from the beginning, because when you go down in lower time frames, these lines will resemble almost the horizontal lines that you are probably already using. So a 45 more or less degree should be ideal. So the risk of a false breakout, an upside reversal, is, in my opinion, very low, because the descending blue line that now serves as immediate support does not intersect with any other line, be it horizontal or dynamic, to reinforce the idea that buyers could step in at these levels. We don't have that attractor made out of a confluence. Instead, these very same buyers could be bringing the price lower to buy at an even cheaper price. We do have a confluence in an intersection of lines awaiting at $1,550 per ounce of gold. This is the intersection that is now the new downside target to be achieved in 2 weeks. We see here the 4th of October to be exact. The intersection. Failure to achieve this target in time would raise hopes among a larger crowd of investors, but until then, this could be a falling knife. So be careful if you plan to accumulate gold at these price levels. Looking for confirming signals. Let me jump here to the chart of Sprott Physical Gold Trust. This is an ETF. It basically mimics what gold is doing. Here on the daily chart, we already see this down sloping channel. We have basically the same price action. Here we can see, interestingly, the intersection. In this case, is pointing to the 26th September, so a little bit earlier than the intersection in the chart of spot gold. And we see where this support originates. You can see this is this swing high here. We had the break up to the upside here, and then we had a very strong price action here which in the price or in the chart of gold, because it's a spot, we see a continuum. We don't have lots of hints that this line could be proven support. We do have here the price trying and testing the level from below, but more convincingly is the price action here in the ETF with this gap here at the breakout of this line, a gap that would be probably filled now with this downside movement that we are now expecting. If we look further into the intermarket landscape, we see also here a deterioration in the price of stocks. So we see the S&P 500 here printing a very large engulfing candle here for this week and still collapsing. This is an engulfing in terms of the anatomy of the candle, not so much for its placement, because it's not happening at a meaningful high, so it's not a reversal pattern as such, but it's an indication that we will probably close the week very, very negative also here. If we look at the yields, 13-year yield, we see it, the price is rising, so this means that the yield is rising, the fall is in the price, so correlated to what is happening in stocks and also in commodities. And finally, if you look at the dollar, we do see here, this is the place where we find more resilience. It's not closing the week in negative as other markets, so we may infer from here that there is some capital allocation here towards cash. But very interestingly, since we are looking at currencies, is to look at the price of gold in terms of other international major currencies. So for instance, if you look at gold priced in yen, we see very elevated prices here. It did print a negative week, but look at the levels. We are here very high, staging a kind of reversal, longer term pattern here, but it's not confirmed. Only a break below this signal line would signal a reversal of fortune here in the yen or in the price of gold priced in yen, but that's not the case. We don't have a break lower below this horizontal level that would eventually correspond to the levels that gold just broke this week. And if we look at gold in other currencies, sterling, more or less the same. It's not printing a lower low, nor it is in the Canadian dollar. And even the euro, which staged a slightly deeper retracement here, gold in euro terms, it did not print any conclusive breakdown. We do have here an interesting resistance being broken at this level, the bounce here, so the critical level is still to be broken in terms of euro, the same with Canadian dollar, and even more so in terms of New Zealand dollar. So going back here to the chart of gold and looking at it from a weekly perspective again in dollar terms, and just to wrap up here, gold still looks attractive from an international perspective. This means that buyers may prefer to let gold fall a little bit further and then set shop at lower levels, and attracting therefore the price of gold lower in terms of US dollars. In the next 2 weeks, the likelihood is therefore more falling prices. An upside reversal from here is not something that the technical landscape is suggesting. Moreover, there seems to be a very correlated retracement across several asset classes. It does not look like a risk on of capital rotation, but rather a more conservative stance by global investors liquidating their positions towards cash. In the next video, we will see which market is the first to reignite the appetite for risk, if there is any, as always following key technical standouts and bringing them to you via YouTube. If there is any specific market you want me to cover, please let a comment below. Until then, be safe. See you in the next video.